This is Agent Mode AI. I'm Abby. Today we're checking three claims at once: AM 118, AM 119, and the vendor economics section of AM 121. They describe three institutional capital cohorts reading the same AI risk surface from three different angles. The asymmetry between how they're behaving is what we want to walk through.
I'm Avery. Frame the asymmetry.
Three cohorts of institutional capital: pension funds and sovereign wealth funds, who manage the longest dated capital in the system; reinsurance, who underwrite the catastrophic tail of the insurance market; SaaS investors, who fund the AI vendors at primary market and secondary. All three read the same AI risk surface. Pension capital is silent. Reinsurance capital is repricing. SaaS investor capital is celebrating. Three institutional cohorts, one risk surface, three different reactions.
Start with AM 118, the pension fund piece.
AM 118 is the claim that the major institutional pension funds and sovereign wealth funds, NBIM in Norway, CalPERS in California, and similar entities globally, have published essentially nothing on AI risk as of mid-2026. NBIM has approximately $1.7 trillion in assets and a published governance position on virtually every other category of systemic risk: climate, cyber, anti-corruption, board independence, voting policies. On AI specifically, the published corpus is thin to absent.
What does the absence mean?
The absence is the editorial signal. NBIM publishes detailed governance positions on emerging risks specifically because of its scale and time horizon. The fact that AI is named in their governance documentation as an area of interest but not anchored to a published policy position by mid-2026 is a structural data point about how the longest dated capital in the system is reading the AI risk surface.
Two readings of the silence.
One reading: pension capital is waiting for the empirical evidence before committing to a public position. The argument from this side is that publishing too early on AI risk locks the fund into a stance the data doesn't yet support. The other reading: pension capital sees AI risk as more diffuse than other categories, not concentrated in any specific holding, hard to express as a portfolio adjustment. The argument from this side is that the absence reflects an analytical gap, not a strategic choice.
Either reading is consistent with the observed data.
Both are. The point isn't to choose between them. The point is that the longest dated capital in the system has not committed to a position. That's a data point worth tracking against AM 119 and AM 121.
Now AM 119, the reinsurance side.
AM 119 is the upstream piece. Lloyd's of London, Munich Re, and Swiss Re have actively repriced AI tail risk into 2026 cyber treaties. The published research from all three is consistent. Lloyd's future set systemic risk content explicitly treats AI as an emerging cyber tail risk category. Munich Re's annual cyber insurance risk report names AI as a catastrophic scenario category and provides loss modeling frameworks that primary carriers reference. Swiss Re Institute's Sigma research published 2025 work on AI-related liability and cyber-physical convergence.
The downstream effect.
Treaty terms have tightened. Catastrophe bond issuance for cyber risk has shifted in the direction the reinsurance signal predicts. Per event retentions at the reinsurer level have moved. The signal travels downstream to primary cyber renewals on a 6 to 12-month delay.
So the reinsurance market is not silent, it's actively committing capital to its position.
That's the difference. Reinsurance capital is shorter dated than pension capital and has direct exposure to catastrophic loss. The published research is the artifact, the treaty terms are the commitment. Both are observable.
Now the third cohort, SaaS investors via AM 121.
AM 121's vendor economics section. ServiceNow's RPO at the end of Q1 FY26 was $27.7 billion, up 25% year over year. Customers at $5 million or more in annual contract value, 630, up from 516 a year prior. Datadog's Q3 FY25 10Q discloses that its AI native cohort contributed approximately 8 percentage points of year-over-year revenue growth for the quarter, with the company's filing language flagging the concentration as a risk factor.
That's vendor-side disclosure. What does it tell us about investor behavior?
Investor behavior follows the vendor-side disclosure. ServiceNow's market capitalization reflects the RPO trajectory. Datadog's market capitalization reflects the AI native cohort's contribution. The capital market response to AI vendor exposure has been to reward growth, not to discount for the concentration risk that the company itself flagged.
The asymmetry.
Pension capital, silent. Reinsurance capital actively repricing AI tail risk in 2026 cyber treaties. SaaS investor capital celebrating AI attributable revenue growth at the vendor level. 3 institutional cohorts, all reading the same underlying AI risk surface, all behaving in 3 different directions.
Why is this the editorial point?
When 3 independent capital cohorts read the same risk surface and behave in 3 different directions, the divergence itself is the editorial signal. One of 3 readings is going to look most accurate in retrospect. We don't know which one yet. What we know is that the pension capital position, silence, is the position that has the most option value if the AI risk surface materializes in either of the directions the other 2 cohorts are pricing.
What the CIO listening should take from this?
2 specific things. First, the reinsurance pricing signal is concrete and observable in your 2026 cyber renewal. The terms tightened upstream. Read your renewal accordingly. Second, the AI vendor concentration flagged in Datadog's 10Q is a leading indicator for how multi-year SaaS commitments price AI exposure. If your vendor's AI native cohort is concentrated, your renewal trajectory carries that concentration risk.
Verdicts.
AM118 is holding. The absence as signal framing is supported by NBIM's published governance corpus on every other risk category. Cadence is 60 days because the next scheduled NBIM governance update will be the first observable signal change.
AM119.
AM119 is holding. Same reading as Episode 1. Lloyd's, Munich Re, Swiss Re published research is consistent. The downstream effect on primary cyber renewals is observable. Cadence is 60 days.
AM121.
AM121 is holding. The SEC filed RPO and AI native cohort numbers are audited. The investor reaction is observable in market capitalization. Cadence is 60 days. What would change any of them? For AM118, a published NBIM or CalPERS AI governance position would close the absence as signal frame. For AM119, a coordinated reinsurance market softening on AI tail risk. For AM121, a material change in ServiceNow's RPO trajectory, or Datadog's AI native cohort growth contribution.
Final word?
The 3 claims, the SEC filings, and the published reinsurance research are linked at agentmodeai.com/holding. The Sunday Brief ships every week with what moved on the ledger.
Holding up. See you next Sunday.